Here is a paradox that quietly ruins retirement plans across this country every single day. The more money you saved in your 401k during your working years, the harder it can become to actually use that money between ages 55 and 59. The tax code treats your own savings like a locked vault with a penalty written on the door, and most retirees facing early retirement assume the vault cannot be opened until they hit 59 and a half. That assumption is wrong. There is a provision, written clearly into Section 72T of the Internal Revenue Code, that lets certain workers begin drawing from their 401k as early as age 55 with no 10% early withdrawal penalty. Not at 59 and a half. At 55. And the people who most need to know about this provision are almost never told, because it is not in the interest of the employer to remind you, and it is often not in the interest of the rollover-hungry financial advisor to mention it either. Today I am going to explain how this works, who qualifies, what traps to avoid, and exactly how to use this rule to bridge the early retirement gap without handing the IRS a single extra dollar. Before we get any deeper, I owe you the same disclosure I always give. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. The rule I'm about to walk through has specific conditions, and if you misunderstand even one of them, the penalty you were trying to avoid can land right back in your lap. The provision is often called the Rule of 55. It says that if you separate from service from the employer sponsoring your 401k, in the calendar year you turn 55 or later, you can take distributions from that 401k without the 10% additional tax that normally applies to early withdrawals before age 59 and a half. You still owe ordinary income tax on the distribution. That does not change, but the penalty layer, which is often the deciding factor, is removed. For certain public safety workers, including law enforcement officers, firefighters, and emergency medical services personnel, the age is even lower at 50. The rule exists in Internal Revenue Code Section 72T, 2, AV, and it is confirmed in IRS Publication 575. Let me put this in real dollars so you can see what we are talking about. Linda was a manufacturing supervisor in Dayton, Ohio, who accepted a voluntary early retirement package at age 56. Her 401k held $480,000. Between 56 and 62, when she planned to start Social Security, she needed about $40,000 a year to bridge the gap. That is $240,000 across 6 years. If she had rolled her 401k into an IRA, as her former employer's exit packet suggested, every dollar withdrawn before 59 and a half would have triggered the 10% penalty. On about $120,000 of pre-59 and a half distributions, that penalty alone would have cost her $12,000. $12,000 lost for no reason other than not knowing the rule. She kept the money in the 401k, used the Rule of 55, and saved every dollar of that penalty. The income tax still applied, as it always does, but the penalty vanished. That is the math bridge you have to see. Now I need to walk you through the traps, because this is where retirees get hurt. The first trap, and it is the one that catches more people than any other, is the rollover trap. The Rule of 55 only applies to the 401k of the employer you separated from. If you roll that 401k into an IRA, the Rule of 55 disappears the moment the rollover completes. IRAs do not have a Rule of 55. Once that money is in an IRA, you are stuck with the 59 and a half rule unless you start a substantially equal periodic payment plan under 72(2)(t), which is complicated and unforgiving. So if you are planning to use the Rule of 55, do not roll the 401k over until after you have taken the distributions you need. Leave the money in the plan. Your former employer's plan administrator has to allow partial distributions for this to work. Most plans do, but not all. Before you retire, request a copy of the summary plan description and read the section on post-separation distributions. Some plans force you to take a lump sum. Some allow flexible partial withdrawals. The difference can be life-altering. Richard, a retired aerospace technician from Texas, learned this the painful way. He separated from his employer at 57, took the advice of a brokerage firm to roll everything into an IRA, and 3 months later needed to pull $25,000 for a home repair. Because the money was now in an IRA, he paid the 10% penalty plus income tax. $2,500 gone. Had he waited to roll over, or split the assets by taking his bridge money first and rolling the remainder later, he would have kept every penny. The second trap involves the year you separate. The rule of 55 requires you to separate in the calendar year you turn 55 or later. That is year, not age. If you leave your job on December 31st of the year you are 54, even if you turn 55 the next week, you do not qualify. The calendar year matters. If you are planning to retire near your 55th birthday, talk to a tax professional about the exact timing of your separation. 2 weeks of difference in your official separation date can mean the difference between qualifying and not qualifying. The third trap is the two-plan problem. The rule of 55 applies to the 401k of the employer you just separated from. If you have an older 401k from a previous employer sitting at a different custodian, that plan does not qualify for the rule of 55 unless you rolled it into your current employer's plan before separation. Here is the strategic move. If you know you are going to retire between 55 and 59 and a half, and you have old 401k balances scattered across former employers, consider rolling those older balances into your current 401k before you leave. Once they are inside your current plan and you separate, in the qualifying year, the rule of 55 applies to the whole balance. This is sometimes called a reverse rollover or an in-service rollover in, and many plans permit it. Check your plan rules. I want to introduce you to Ruth. Ruth was a hospital nurse manager in Tampa, Florida, who had 3 retirement accounts when she hit 54. She had her current employer's 401k with $300,000. She had an old 401k from a hospital she left 10 years earlier with $80,000. And she had a traditional IRA with $40,000 that she built from earlier rollovers and contributions. Ruth sat down with a planner 9 months before her planned retirement. They rolled the old 401k into her current 401k before separation. They could not roll the IRA into the 401k easily because while some plans accept IRA rollovers, hers required pre-tax rollover proof that was difficult to obtain on the IRA. So they left the IRA alone. When Ruth retired at 55, she had $380,000 inside a plan that qualified for the rule of 55. She used $45,000 a year for 4 years to bridge until 59 and a half, never paid a penalty, and at 59 and a half, she had full access to all her accounts. She paid income tax, of course, but the penalty was zero. Saved herself roughly $18,000 in penalties across that 4-year bridge. Now let me address something that comes up over and over. Some retirees confuse the rule of 55 with the substantially equal periodic payment rule known as 72T SEPP. They are not the same. SEPP is a separate provision that lets you take penalty-free distributions from an IRA or 401k before 59 and a half by committing to a series of substantially equal payments calculated using one of 3 IRS-approved methods, continued for at least 5 years, or until age 59 and a half, whichever is longer. SEPP is inflexible. Once you start, changing the payment amount or stopping before the end of the commitment period triggers retroactive penalties and interest on every distribution you already took. The rule of 55 has no such commitment. You can take as much or as little as you want, whenever you want, as long as the plan allows partial distributions. It is far more flexible. If you have the choice, and you qualify for the rule of 55, it is almost always the better path. Another thing I want to say clearly. Your 401k administrator will issue a Form 1099-R for your distribution. The code in Box 7 of that form matters. For a rule of 55 distribution, the correct code is usually Code 2, which signals an exception to the early distribution tax. If the administrator mistakenly codes it as Code 1, which is an early distribution, with no known exception, you will have to file Form 5329 to claim the exception. It is not fatal. It is not a disaster. But it is a paperwork headache you should not have to deal with. Before you take the distribution, call the administrator and confirm how they will code it. Get that confirmation in writing if you can. If they refuse, to code it correctly, Form 5329 with the appropriate exception code will get you there, but it is a hassle you can avoid with one phone call. Let me also bring up withholding. By default, 401k distributions have 20% federal income tax withheld. That is mandatory withholding, not optional. You cannot reduce it below 20% on a lump sum distribution. For periodic payments, you can adjust the withholding using Form W-4P, which is the form for pension and retirement plan withholding. If 20% is too much for your situation, you may receive a refund when you file your 1040. If 20% is too little, you may owe additional tax plus an underpayment penalty under the safe harbor rules. Many retirees find that quarterly estimated tax payments using Form 1040-ES are cleaner than relying on withholding because they can fine-tune the amount to match their actual situation. Work with your tax professional to model this out before you take the first distribution. Let me put a few more numbers on the table. IRMA, the income-related monthly adjustment amount that raises your Medicare Part B and Part D premiums, does not typically apply until you enroll in Medicare at 65. But it is calculated on your income from 2 years prior. So if you take a large 401k distribution at age 63, that income can raise your Medicare premiums when you turn 65. The current IRMA thresholds begin at approximately $103,000 of modified adjusted gross income for a single filer and $206,000 for a married couple filing jointly. Crossing one of those thresholds by even $1 can raise your Part B premium by roughly $70 to $80 a month per person for a full year. Plan your distributions with this in mind. Taking $40,000 one year is very different from taking $110,000 one year and $10,000 the next. Walter, a former truck driver from Nevada, retired at 56 and used the Rule of 55 for 3 years. He kept his distributions around $32,000 a year, combined with his wife's modest part-time earnings. When he turned 65, his Medicare premiums were at the standard rate because his modified adjusted gross income had stayed under every IRMA A tier. A colleague of his, who took a one-time $70,000 distribution at 63 to pay off his mortgage, crossed a threshold and paid an extra $960 in Medicare premiums for the year he turned 65. Same situation, different sequencing. The Rule of 55 gives you the flexibility to sequence wisely. Use it. I want to address one more thing before we close. If your employer contributed to a pension plan in addition to your 401k, the Rule of 55 does not apply to the pension because pensions are typically structured differently. Defined benefit pensions have their own early retirement rules, usually with actuarial reductions for taking the benefit before the plan's normal retirement age. Those reductions can be significant. If you have both a 401k and a pension, map them both out with your planner before you set your retirement date, because the combined picture can change everything about when it makes sense to stop working. Let me circle back to a question I get often. What if I am 54 and thinking about retiring? Can I wait 1 year and qualify? Yes, if you can hold on until the calendar year you turn 55 and then separate. You qualify for the Rule of 55 on your current employer's 401k. Do not leave at 54 thinking you can claim the rule a year later. The separation itself must occur in or after the calendar year you turn 55. Timing is everything. What if I am 57 and already left my employer? You still qualify on distributions from that 401k, provided the plan allows partial distributions and you have not rolled the money elsewhere. If you left at 57, but you are now 58 and the money is still in the 401k, you can take distributions now under the Rule of 55 until you turn 59 and a half, at which point all accounts, including any IRAs, become penalty-free anyway. What if my employer went out of business? That is a harder question. If the 401k plan was terminated and the money was forced distributed, or transferred to a default IRA, the Rule of 55 may no longer apply. Work with a qualified professional to trace the money and determine what options exist. Sometimes state unclaimed property offices hold these funds. Sometimes a new custodian took over. Every case is different. The theme I want you to walk away with is this: the tax code has quiet doors cut into it for people who know to look. Most retirees are never shown those doors, and they walk past them their whole lives. The rule of 55 is one of the most valuable doors available to anyone retiring between 55 and 59, and using it correctly can save you $12,000, $15,000, $20,000 or more, depending on how much bridge income you need. The key is to know the rule before you separate. Once you separate, your options narrow quickly. Planning matters. Sequencing matters. The calendar year of your separation matters. Eleanor, a retired accountant from Pennsylvania, once told me that the best financial decision she ever made was taking 3 months of unpaid leave at age 54 to study her own retirement plan before pulling the trigger. She read her summary plan description twice. She met with 2 tax professionals. She got every detail in writing. When she finally separated at 55, she had a crystal clear plan for bridging until Social Security, and she executed it without a single costly mistake. 3 months of preparation saved her what she estimates was $22,000 across 4 years. That is a rate of return that no investment can match. I want to leave you with one specific action step. This weekend, pull out your most recent 401k statement and find the summary plan description. If you do not have a copy, call your plan administrator and ask them to send one. Read the section on post-separation distributions. Look for the words partial distribution, installment, and period certain. Make a note of what your plan allows. If your plan only permits lump sum distributions after separation, you will need a different strategy, and knowing that now lets you plan around it. If your plan permits flexible partial distributions, you are in the strongest possible position for an early retirement. If you found this useful, I would be grateful if you subscribed to the channel and turned on notifications, because the next video builds on this one. We are going to cover what happens at 59.5 when the full menu of retirement accounts opens up, and how to sequence withdrawals across 401ks, IRAs, Roths, and taxable accounts to pay the least tax possible over the rest of your life. That sequencing is where fortunes are preserved or squandered, and I will walk you through it the same way I walked you through this. One rule at a time, in plain English, with real numbers. Thank you for giving me your time today. It matters, and I do not take it for granted.